and sources of demand. In practice, currency-wise BP deficit surplus calculated. Yes, we do. So at the end of the balance of payment sheet, you will see balance of payment deficit or surplus. But don't come to the conclusions by looking at that figure. Nevertheless, we calculate it, and if there is a deficit, finally at the end of the year that has to be settled. How do we settle? By reducing our foreign exchange stock reserves. If we have a surplus, that has to be settled. And how do we settle it? We absorb the surplus to the foreign currency reserve. So, which means actually at the end of the year, it has to be zero. So, all the payments are made equal to all the receipts, making balance of payments, deficit or surplus, zero at the end of the year. That's what you see in the balance of payment sheet. Okay, now we mentioned about foreign exchange market demand and supply. So I'm going to explain you further down the line. Demand for dollars, how does it change with the exchange rate movements? So demand for dollars can be explained through imports. So we are going to look at import side only, because export side is important for supply. So here we are looking at trade in goods and services and how demand change in line with exchange rate appreciation or depreciation. So I'm going to take a simple example to a case of imports. Suppose that you want to import something and the foreign price of what you are going to import is $2. So yesterday I said what you import for $2 is a chocolate. So you want to import chocolates and the price of one chocolate would be $2. Exchange rate is 100 rupees per dollar. So how much rupees you want to pay to the bank? 200. To get that $2. And the amount of chocolates that you want to import would be 280. So how much dollars you need now to buy 280? You need $560. That is demand for dollars. We demand $4. Now suppose the exchange rate depreciated, so that next time it became 125. The foreign price has not changed, it remains the same throughout. But what you are paying to the bank in rupees will change now. Earlier you paid 200, now you have to pay 250 to buy the same $2. So the commodity is now becoming expensive in the domestic market. Of course, now we are quite familiar with that during the last couple of years, and we have seen how the imported stuff becoming more and more expensive. And one of the reasons is exchange rate depreciation like this. So you now reduce the imports quantity that is coming from our low of demand. You don't buy 280 now, you can buy 240 as demand goes down. To buy 240 chocolates, you need to spend $480. Next period, it has depreciated further 150. So now you need to pay to the bank 300 rupees to buy $2, becoming expensive. So the local demand for imports further goes down. And how much dollars you demand now? 400. So what you see now, when you compare this column, two red columns, exchange rate, and when the exchange rate depreciates like this, and here we have demand $4, and the demand $4 decline. So you have if you are going to draw on the vertical axis, you have exchange rate and the amount of dollars demanded on the horizontal axis. So you have a downward sloping demand line when you plot these two columns. Why there is downward slope in demand? This is the explanation. This is exchange rate. As exchange rate depreciates, domestic demand for foreign exchange falls. Domestic demand for foreign exchange falls. That's what you saw here. Last column. Why? Because imports become expensive. Right? Imports become expensive. That's what you saw here in our domestic market. So that's the reason why we have a downward sloping demand curve. Let's look at the supply side. So to explain that, we take exports, our exports. So we have domestic exports, and the domestic price as 2,000 rupees. Imagine a tea packet worth 2,000 rupees. There is no change in domestic price. It remains the same. But the exchange rate has depreciated like earlier. Now I have added additional column here, this one. That is the inverse of the exchange rate. Rupees per dollar and dollars per rupee. Why did I do that? Because to look at the export from importer's point of view, we send export tea to European market so that European buyers look at it from their point of view as importing from Sri Lanka. It's important for us, for our discussion. And now let's look at what happens. And so under this price and this exchange rate, foreigners should pay this amount of dollars to buy 1 rupee. With that price, the foreign price of our commodity that we export, tea packet, would be $20. So they demand for 10 units and they supply $200 for us to buy 10 units of tea packets. They pay $200. They supply $200 to us under this exchange rate. Now, next time exchange rate has depreciated 125. You can see the inverse of that one. That means US dollars per rupee has actually declined there. Dollars per rupee decline. It means rupee becomes cheaper for the foreigners. So when you look at this column, the third column, you can see each time when the exchange rate depreciates, the rupee becomes cheaper for the foreigners' point of view. Now, under this exchange rate, 125 a dollar, owes 0.008 per rupee, the foreign price would be $16. What has happened? The foreign price has declined. And it declines further when the exchange rate depreciates further and further. So, which means now if our commodity becomes cheaper in their market, they can increase what they want to buy. So that they can pay more because the commodity has become cheaper. So they supply more dollars. Which means now when the exchange rate depreciates, we have an upward sloping supply line for foreign exchange. Upward sloping. So the reason is given here why when the depreciation happens, domestic supply of US dollars increases, like we saw here, because exports become cheaper in the foreign market. And as a result, the demand rises in the foreign market. That is the reason. Depreciation makes our commodities cheaper in the world market. If foreign importer does not convert it to LKR, I cannot understand this question. We are actually constructing demand and supply relationship. So let's look at how we construct demand and supply. Now I talk about the current account transactions. Now I also mentioned the balance of payment consists of capital and financial account transactions. So financial accounts transactions, the typical ups and downs with respect to exchange rate depreciation, appreciation. We can take a bond, domestic asset market. So there are actually two cases. One is foreigners buying our rupee assets, that is this column, and locals buying foreign assets, that is the second column. Okay, so both are important for our foreign exchange receipts and payments. So let's first look at this one. This is the one which is important for us. Foreigners come in to buy our rupee asset. Suppose that the price of the asset, that is according to the face value, it is 15,000 rupees. And the interest rate, actually it is the coupon rate, is 5%. So once the maturity period is completed, if it is 1 year, so the investor get his principal and the interest. So what should be the interest for 15,750 rupees? What was his principal? The investment 15,000. So that his total return to investment would be 15,750 at the maturity. Now suppose a foreigner comes to buy this amount of assets, and he has to spend he brings $100 because the exchange rate is 150 rupees per dollar, 150. So that if he brings $100, he can buy, open that whatever the account, local account, Sierra account, and $100 can be converted to 15,000 rupees and purchase the rupee assets, the bonds. Now, after the maturity period, we find that the exchange rate has depreciated from 150 to 160. So the investor gets his return, and that is how much he gets. He gets 15,750. Now he wants to get his money back in his own currency, so he tells the bank to pay it in dollars. How much he gets? He gets 98.4. So actually the foreigner has made a loss because of depreciation. If it is an appreciation, the next two rows will give you what will happen, because appreciation 140 rupees a dollar. In that case, he will make extra profit, not only because of the coupon rate 5%, but also he will get additional some money because of the exchange rate appreciation. So altogether, his return would be 112.5. Now, if you look at the local residents' investment in foreign assets, that is this one, you will see exactly the opposite. So you can do it late at home. But here, now this is the case now, and explanations are given here. Because the demand for and supply of foreign exchange through trading assets, unlike in the current account, trading goods and services. In trading assets, it is determined by exchange rate speculation. because you are looking at future market during the maturity period. So how do we look at that case? If the current exchange rate is above the market rate. Now, first we look at the second case. That is, we are quite familiar with that. If the current exchange rate, that is E, is below the market rate, for example, 100. In other words, it means actually the current exchange rate is overvalued. If you think that the rupee dollar exchange rate now it is trading at 320 and you think that it is somehow for whatever the reason overvalued, and during the maturity period of 1 year it should depreciate in the future to 400 rupees, what will happen? That is speculation. You are speculating what will be the future exchange. If you are speculating it to be a depreciation, then this would be the result. Demand for rupee assets will be lower. Therefore, dollar supply would be lower. At the same time, those who are holding Sri Lankan bonds, rupee bonds, they want to sell it immediately because currency is going to depreciate in the future if they hold it onto. So that demand for dollars would be higher. So you saw the two sides, both sides. Supply would be lower, demand would be higher, which means we have excess demand for dollars, resulting in a net capital outflow. Net capital outflow. So if the capital outflow, if there is a net capital outflow, obviously the exchange rate depreciates. So whatever the public, the foreigners speculate is going to be true. It will come true. Now you can look at the first case. It is about an appreciation. If the currency is appreciating, so that you speculate appreciation for the next half a year. So now it is 320 rupees a dollar. So you expect it is going to be 250 rupees a dollar in the future by the end of the year. Anybody thinks that? Then the demand for rupee assets would be higher. That means there will be increased supply of dollars. Also, sale of rupee assets would be lower so that demand for dollars, people don't want to take their money back. It will be lower, creating excess supply of foreign exchange in the market, which means there would be a net capital inflow, which will actually appreciate the exchange rate. So that's how these operations in the stock market, in the bond market, that's why actually in our bond market, there is a cap for foreign purchases. There is a cap. And that cap is, I think at the moment, 5%. But before we come to this crisis situation, it was some time back, it was 12%. But now it is reduced to 5%. They cannot buy as much as they want, looking at our higher returns for the government securities because it's highly volatile case, highly volatile. Now, if you look at the exchange rate movements, what is the more stable and long-term foreign exchange source? Trade, international trade. Whereas, unfortunately, we haven't done that. So our exchange rate market is dependent more on highly volatile, temporary foreign exchange inflows and outflows. That is this one, stock market, bond market. So they will come today and go tomorrow. Highly volatile, creating exchange rate uncertainty. Right. Now, after we do these things, we can draw our exchange rate. Let me show you. I'm going to show you here. This is the demand and this is the supply. So we are at point A. Our exchange rate would be E0. You can see the red line. For some external reasons, the demand rises. Demand rises. For example, think that foreigners wants to sell all their domestic assets, rupee assets held by the foreigners, and the stock market, company stocks held by the foreigners, and they want to get out of the Sri Lankan foreign exchange market because they see uncertainty. What will happen? We shift the demand line to the right. So you can see the red line, and the market adjustment is the movement to point B. That means our exchange rate should depreciate. Like depreciation is going above the upward direction. Okay, moving upward direction means number of rupees per dollar. But if the government doesn't like it, if the central bank wants to keep the exchange rate as it is, at E0, what it does, the central bank has to do, central bank must meet this supply, shifting the supply line here, so that our equilibrium point in that case would be point C. So that is the adjustment through the central bank intervention. How does it intervene? It has to sell foreign exchange to meet this excess demand. You can see there is an excess demand. That demand has to be met, covered by increase foreign exchange supply by the central bank, which means actually central bank has to withdraw from its stock of foreign reserves and release to the commercial banks. So if it is the market adjustment mechanism, point B is market adjustment, and that adjustment will take place with exchange rate depreciation. And if it is central bank intervention, and central bank intervention means selling foreign exchange in the case of deficit, and also buying foreign exchange in the case of surplus. So what does it affect? It affects money supply. money supply. Okay, we will look at that later. And the market adjustment affects exchange rate. This one, market adjustment, this one affects exchange rate. Intervention is adjustment, this one affects money supply. Now, these two things, market adjustment and intervention is adjustment for the central bank, these are actually related, historically related to exchange rate systems. Now, for example, floating exchange rate or flexible exchange rate. That means demand and supply forces clear the foreign exchange market through exchange rate depreciation or appreciation. If there is BOP deficit, it means there is excess demand for dollars. In that case, in the adjustment process, exchange rate should rise. Rise means depreciate. Number of rupees per dollar should rise. That means rupee depreciates or rupee gets weaker. In the case of surplus, that is excess supply, exchange rate falls means appreciate. Now, fixed exchange rate system. Before we come to floating exchange rate, that is before 1970s, the world had fixed exchange rate. I will explain you the historical process in a little while. Fixed exchange rate means, sometimes we call it peg, because the currency is pegged to an other currency, hard currency, or a basket of currency. Central bank intervenes in the foreign exchange market to maintain that fixed rate. It affects money supply. How? For example, BOP deficit. That means there is excess demand for foreign exchange. Central bank has to sell foreign exchange. Where does it get foreign exchange to sell? Not by printing. From the reserves. So the reserves should fall. In the process, money supply falls too. Why? The central bank bring dollars to the commercial banks, and commercial banks have to pay to the central bank. Where does it get money to pay? From which account? The commercial banks' reserve accounts maintained at the central bank. So that capital letter R, remember M0 equal C plus R. That R should decline, which means money supply should decline. That's the connection between the foreign exchange, one of the connections between the foreign exchange market and money market. In the case of surplus, excess supply, and central bank can purchase foreign exchange. So that foreign exchange reserves should rise and money supply should rise too. Why? The central bank pay rupees to the commercial banks. It will be added to that R, M0, reserve money. So the money supply, stock of money should go up. Historically, The world had, let me see these comments first. How do we know that in a given situation, exchange rate is above or below the market rate? It's all about speculation, speculation about the future. It's not that you know it below or above the market rate. Of course, if you do the calculations, real exchange rate calculations, I will explain that later. It is another thing, another subtopic concept that we need to understand, real exchange rate. With that, even the central bank does it. We know whether the exchange rate is below or above the market rate. In fact, in business language, it is called overvalued or undervalued. Overvalued means below the market. Undervalued means above the market. That can be calculated, but mostly it depends on speculation. How do you speculate about 320 rupees per dollar now? Now, I think it is 320. By the end of the year, what do you expect? That's it. The second, what are the instruments that CB uses to buy and sell foreign exchange from banks market? What are the instruments? What does it mean? There is a mandatory requirement that from every foreign exchange received by the banks, they should cut. In fact, recently, central bank reduced it from 25% to 15%. That is a regular thing. In addition, when the central bank see that there are excess foreign exchange coming to the market and the exchange rate is coming under pressure for appreciation, if the central bank wants avoid it, avoid it, it tells the commercial banks to increase that rate, mandatory purchase, and then the commercial banks will convert it to rupees. So before 1944, before 1944, the international monetary system in the world, it was called gold standard because there was no particular exchange rate system at that time. And nobody wants to trust in anyone else domestic currency, not even dollars. So nobody wants to accept others' currencies, trusting that it is good to keep in dollars. So everything, the world transactions depends on gold. So exports, imports depends on gold. So physical gold shipments were in the world. Physical gold shipments. When there are trading activities expanding in the world. So Sri Lanka was located along the important east-west shipping lane. So there are thousands of ships passed by Sri Lanka. In fact, Sri Lanka was an important stopover for these ships also. There are more than 200 shipwrecks around the country because sinking ships, shipwrecks is not a new problem for Sri Lanka, new thing for Sri Lanka. It has been there for thousands of years. So there might be gold ships also, ships carrying gold, which have sunk in our Sri Lankan waters. At the moment, we have found more than 200 ships under the water around the country. That's a good source of tourism promotion also, but nobody has yet discovered it as a source of tourist attraction. But of course, the tourists know that, some of the tourists know that, and they come to Sri Lanka particularly to dive and go to these ships, which are lying down under the seabed. So the trade, world transactions, international trade expanding rapidly, so that the gold standard system to make the payments in gold, this one run into problems. What is the problem? There are a number of problems. First one, the gold supply was much more inelastic compared to world trade expansion. That is one reason. So the gold is becoming more and more valuable compared to world international trade. The second problem, some countries had permanent gold stocks getting accumulated, while some countries had permanent deficits. So the 3/4 of the world's gold stock got accumulated in the United States. Even today, the largest gold stock in the world is with the United States. That is the third problem. So then the international transactions, international trade, their expansion remained constrained by this payment system, so that the world, the economists gathered at the conference. They had the conference, more than 1 month long conference, probably the longest conference in the world, economics conference in Bretton Woods, to decide international monetary system. And that is where the fixed exchange rate system was introduced. This one. The countries, all major countries, Western countries, they agree to define their exchange rate, officially declare their exchange rate. That means the external value of their currency against what? Against the US dollar. So that's one of the major turning points in the international monetary system in the world, at which the US dollar received that international recognition. And even up to now, it remains the same. So all the countries attended the conference or became the members later on, the IMF, declare their exchange rate against the US dollar, fixed exchange rate. This conference was also important for giving birth to two important institutions. One is the IMF, second is the World Bank. World Bank for construction and reconstruction purpose, development purpose. IMF for looking after or through for intervention when the countries are having balance of payments issues. But over the years, IMF has changed its mandate. Today, IMF is breaking all the time fiscal issues, not the balance of payments remedies. It brings fiscal remedies. is mostly fiscal. That's the new definition for IMF. Is mostly fiscal. Anyway, this fixed exchange rate system would not, uh, it did not remain more than 25, well, in about 25 years' time, the world realized again they cannot continue with that either. What is the reason? One reason is actually the exchange rate of the dollar again, because now other countries have to declare their currency value against the dollar. So that dollar has to declare their value, its value against gold. So still indirectly the world currencies, they were tied up to the amount of gold available. So gold prices in the world market, because of the supply inelasticity, the rising and the fixed price between gold and US dollar could not, that is the responsibility of the US to maintain that fixed price. They could not maintain it. So they gave up the abandoned that link between dollar and gold so that the other countries, Western European countries, Japan, they also gave it up in the early 70s. And developing countries move into, as they also started policy reforms, they most of them move into manage floating exchange rate, including Sri Lanka. Sri Lanka has always been in many of these international affairs. Sri Lanka has been always on the front line. So Sri Lanka also did that in 1977. That is where we started this flexible and managed flexible exchange rate systems. Does it provide the solution for international finance? Not at all. Even flexible exchange rate is not a perfect solution. It's not a perfect solution. It has created a lot of exchange rate risk and uncertainty. Risk